Now today, I want to talk to you about the ATO 6-year rule. The 6-year rule means if you purchase the property where you originally treated it as your owner occupier for a certain amount of time, you can actually treat it as an investment when you move out of it for up to 6 years. And the reason why you should be taking advantage of this, if you can, is because before you start investing in other states, you should try to invest in a property within your own state if you can afford it. Okay, everybody, imagine you buy a property to live in, then you should turn it into an investment, and for up to 6 years, you can claim the depreciation, the interest charge, and also receive rental, right? And any profits you've made within that time frame is tax-free. I'm your host, Tony Xia, and thanks for joining me on another episode of the Mortgage Chat. Now, today, I want to talk to you about the ATO 6-year rule. And you know what this is? Well, let me explain it a little bit more better for you. So the 6-year rule means if you purchase the property where you originally treated it as your owner occupier for a certain amount of time, you can actually treat it as an investment when you move out of it for up to 6 years. So what does this mean? So what is the 6-year rule? The 6-year rule is when you convert the property into an investment, you can claim the interest deductions on the loan, you can claim the depreciation, and you can receive rental income because it's an investment property, obviously. So this is the kicker. So from day one, when you treat it as an investment, and if you sold it within 6 years, any profits that you've made from that property is tax-free on the profit. So if the property was worth $1 million when you moved out of the property and you sold it for 1.5 mil within the 6 years period, that $500,000 profit that you've just made there is actually tax-free, as long as you've sold it before the 6-year period. Yep, you got it right. It's called the 6-year rule under the capital gains law. Now, I'm not a tax accountant. I'm not giving you tax advice. What I'm laying out here is what you can find on the ATO guidelines. Better yet, go ask your accountant what the 6-year rule is. And the reason why you should be taking advantage of this, if you can, is because before you start investing in other states, you should try to invest in a property within your own state if you can afford it, right? So this is because the capital growth is going to be there. You can leverage off that property to invest in other assets. And guess what? When you sell it within that 6-year period, it's capital gains free, right? So it's tax free. You don't pay any taxes on it, which is fantastic, right? So this is how it worked out for one of our clients. So originally, they went to see a rent vesting specialist, right? Where this rent vesting specialist was trying to sell them properties all around Australia. So these clients were actually from Sydney themselves. And this specialist was telling them, hey, you should be investing in Queensland, WA, all that stuff, right? So they came to us, they looked at the borrowing power, they asked for our advice, and we said to them, look, why haven't you considered purchasing a property in Sydney or Newcastle or anywhere else and take advantage of this 6-year rule? Now, that's because back then, the property prices hasn't really boomed back then yet, right? So they purchased it just before COVID, which worked out very good. Since COVID, there's probably been 2, you can even call it 3 property booms, okay? And they took advantage of it. So what these clients did, they actually purchased a property up the Newcastle area back in 2020 for around $800,000. And they stayed in the property for a little while just to ensure it was their primary place of residence. Now, after a while, they actually moved closer to the city, okay? And they started renting an apartment because it was closer to work. They liked the lifestyle. Now, at the same time is what they've done with that property is just before they moved out, we've converted that property into an investment loan, interest only, and we drew some equity out because the property price went up significantly. So the equity they had, they started investing in different states to create wealth. And they didn't want to purchase too much in Sydney because it was just too expensive and it was too hard to sustain all that debt with the rental yield in the Sydney market not being as high as other states. So they started spreading the risk a little bit more. Now, as time went by, the property grew, we drew more equity out, and they purchased more investment properties, okay? So that's how they started leveraging and started investing in more properties while renting, right? So, and because they were able to keep this property as an investment with the 6-year rule, they were able to claim the deductions, receive rental income, pretty much treated this property as an investment property, okay? And still allowed to reap the benefits of tax-free when they sell it. So remember, back in 2020, they purchased this property for $830,000. Now, they've got the appraisal from a few agents, and we've also done a bank valuation on this property, which came back at $1.405 million. That's an uplift of $575,000. So if they sell it within that 6-year period, which I'm hoping they will do, that $575,000 is tax-free. Not bad, isn't it? Okay. Now, obviously, before they sell it, we have to restructure the existing loans because they've leveraged off that existing property. So all that equity we took out from that Newcastle property, we have to rebalance it back into their investment properties that they purchased it for. So therefore, they can still maintain the tax deductions on all those loans, because if they don't rebalance the portfolio and move that equity that leveraged off from the Newcastle property back into the respective investment properties they used it for, if they pay out that loan, they've lost tax deductibility on all those debts. Okay, so that's the first thing we had to do before they sell the property and pay off those loans. So now they have this $575,000 that's going to hit their bank account tax-free. Now they can stop reinvesting. It makes them a lot more easier for them to purchase a property as their primary place of residence in Sydney now, because now they've got a big chunk deposit to purchase the new home. Because they've been reinvesting the last 5 years, now they've got that big chunk of deposit to purchase their primary place of residence, their new owner-occupied property, because they don't want to reinvest anymore. They want to buy their owner-occupied home now because they've got a bigger family, they've got a kid now. So worked out perfectly for these people. Okay, so to break it down, they purchased the property for $830,000. They've leveraged off it. They've treated the property as an investment property. They were able to invest in more properties by leveraging off the Newcastle property. They were still able to reap the tax benefits from that Newcastle property while renting. Okay, and guess what? That $575,000 for profits, hopefully, is tax-free. So why is it worth considering purchasing an owner-occupied property right now before you invest in other states? It's because of this 6-year rule, if it works out for you, right? But the problem is, me being in Sydney, the average property price is around $1.6 million for a house right now. So it's very hard for a first home buyer to buy a property for $1.6 million. At the same time, you're going to be very highly negative geared from keeping that property, because the rental yield on that is going to be around 2.5% to 3%. Okay. But if you buy in Newcastle area, hopefully, or South Coast area, you can probably find a cheaper property with a better rental yield, right? So it's a lot harder to do now than before. But if you're in another state and you can do it, please consider just talking to your accountant about it, about the 6-year rule before you start investing in other states, because my clients just really benefited from this strategy. It was a 5-year plan and it worked out for them. Okay, I'm not saying it's going to work out for everybody. It's a good time to have a chat about it before you buy your first investment property, because the growth for the next 5-6 years for the 6-year rule, and you can sell the property for a massive profit and it's going to be tax-free. It's going to benefit you substantially when you want to buy your next owner-occupied property and potentially treat it as your forever home. Okay, guys, so like I just said, I'm not a tax accountant. Please ask for specific tax advice from your accountant or read up on the ATO guidelines. Just type it up on Google, 6-year rule, ATO, it's all there for you. So I hope you like this video. Please stay in tune. Please keep in touch. Watch out for the next few videos because it's going to be something very special for you. Take care.